The biggest debate within the investing community has always been dividends versus growth. Now, as you guys know, this ETF-focused channel focuses more on distributions, aka dividends, than it does growth ETFs. I have another smaller channel that focuses more on growth ETFs and growth stocks that sometimes pay dividends. But this is an income-focused channel. So I am, of course, an income-focused investor. Now, what I do with that income might set me apart from other income-focused investors, but today we are going to discuss the reason why I focus primarily on dividends and on income. Now, that doesn't mean I don't hold some growth stocks, some growth ETFs, because I definitely do. And in fact, I love when we can get a great piece of both. Some dividends and some insane growth over time. And that's what we're going to be looking into today. Some stocks that have done just that. So I hope you guys enjoy this full breakdown on why I am a dividend-focused investor over just a primarily growth-focused investor. As always, thank you guys so much for watching. If you're interested in dividends and ETFs, check out my channels. Let me know what you guys think, and let's roll that intro. So we are going to cover some examples of growth and dividends overpowering just one or the other. Now, one really important thing is our baseline. So I am using Invesco's QQQ, one of the most popular ETFs for growth that has performed extremely well over the past couple of years. And if you don't believe me, I'm going to show you via their website. But I wanted to point out what is in this fund. So the Invesco QQQ ETF tracks the NASDAQ 100 index, giving you access to the performance of the 100 largest non-financial companies. Now, that's the main thing. It's non-financial companies on the NASDAQ. The fund and index are rebalanced quarterly and reconstituted annually. And this is an absolutely insane. The net market value is $284 billion, which is just insane. So let's go over what has made this one stand out and why I'm using it as the baseline for the growth ETF argument. Pulling all of this from the Invesco website, it's an insane ETF, I will say. We can see it has 443% more returns than the S&P 500 since 1999 when the fund launched. This is insane. Now, you guys know I'm a huge fan of SPY. I love the S&P 500. QQQ has outperformed it significantly. A 1,080% difference to 636%. Absolutely insane. The returns have been astronomical. If you had put 10K into QQQ 10 years ago, it would currently be worth $48,000 in 10 years. That is wild to think about. And yes, we've had some really good markets, and that is key for a lot of these growth ETFs, but there's reasons behind why I'm choosing QQQ. It's definitely one of my favorites. You guys know I own VOO, I own SPY. Lots of factors weighing in on this, but I think Invesco's QQQ is the best baseline for us to use. So let's see what stocks we are going to be comparing to QQQ. We're going to look at each individual stock first on Google Finance. We're going to talk about the dividend yields and kind of how the growth has been since the inception of these stocks. And then we're going to compare them all in the drip calculator. Now, you can see I have QQQ plugged in already. And over the last year, it's up 3.51%. On the 5-year, 103%. And all time, it is up 718.5%, which is absolutely insane. This is not going to be easy to beat, and that's why a lot of these funds these stocks that I've chosen are some of my favorites. And I will say I own a good portion of 3 or 4 of these. So I'm a little bit biased, but let me explain why as we go through each of these. Realty Income is one of the most popular REIT stocks I've ever talked about. I've been talking about this one since the beginning, and it is one of the stocks that I've owned for the longest. And there's a good reason for that. It pays a very consistent 5.5% yield, and we can see over the last 5 years, it's up 20% less than QQQ. But if you go to the max chart, it's up just under 600%. And that is since 1994. So if you looked at just this, you would say, hey, it has a worse return than QQQ. But that's not the case. Because see this area down here when you could have bought really early at $11, $12? Well, it was still paying out dividends. It's been paying out dividends this entire time. Now, one huge factor that I haven't talked about yet is these funds outperform QQQ with their dividends reinvested. And I like to think of that as kind of an equal playing field, because with QQQ, to really compare the return, you're not going to be selling out little pieces over and over and over again for income. You're just not. You're using it as growth ETF. You buy it and you forget. And that is what I do with these dividend stocks. So again, Realty Income, it's very large now. It definitely had better growth at the beginning of this fund, of this stock's life, but that 5.5% dividend over 30 years has made a significant difference. Of course, we have to do my fan favorite, Main Street Capital Corp. It has a nice 5.77% dividend yield, not including special dividends, which it has been paying out an insane amount of special dividends. Things are shifting. The interest rates are kind of moving all over the place, so it may not continue that trend. But all in all, this is a fantastic pick in my opinion. I have owned this thing for so long. It's up 113.5% the last 5 years. Max up only 246.67%. So you might be thinking, well, how is this anywhere near QQQ? This one has been trading for a little bit less, about 7 or 8 years less than QQQ. But again, those dividends and those special dividends make it an absolute insane high return stock. And it's why I love these. It really is. And this is what got me more focused on dividend investing when you compare it to just growth. Next, we're going to jump into another REIT, which has an insane return. NNN REIT is one of the most underrated REITs that is right up there, in my opinion, with Realty Income. It's got a 5.6% dividend yield. It does pay quarterly, which is a bummer. The others so far have paid monthly, which I love. But that is not anything really to cry about when it comes to this REIT because it is insane. We can see it's beaten up the last 5 years up only 40%, and Max up 233%. So how is this thing going to compare with QQQ? Well, again, this one's been trading for even longer, which is absolutely crazy. So, I mean, you may not believe me, but I promise when we get to that drip calculator, you'll see how these stack up to that insane growth ETF. Altria Group might seem like a cop-out, but this is one of the most popular dividend king stocks. It's up 35% on the year, up 46% the last 5 years, and Max up 6,000%. It's been trading since 1985. This thing is a growth machine paired with some insane dividends. And I'll tell you, it's hard to beat MO. It really is. I don't know what the future of the stock holds with the tobacco industry. I don't know anything about how it's going to perform, and I don't actually own MO myself. I will say that this is the only one so far that I don't own, but maybe I should with this 6,500% return. But again, these dividends are really what kick out because you're able to compound over a long period of time, which is something that you cannot do with growth ETFs. And that's why I love dividends. Even if it pays a small dividend, QQQ pays about 0.68% as a dividend, which is very, very low, $2.99 a year. But at least it's a little bit of dividend that you're getting alongside that insane growth. But when you can factor in a little bit more dividend and maybe a little bit less growth, the power of compounding makes a significant difference. And that's what we're going to see. I have one more to show you guys. This one is very, very interesting, and I know you guys have heard of it. Now, I do want to be more fair. ARCC has not outperformed QQQ. This is a really popular BDC, one of the largest, and it has a near 10% dividend yield. If we go to the 5-year chart, we can see it is up 71% and all-time up only 30%, which is the main reason I think it hasn't outperformed. It doesn't have the growth that QQQ has. It has been trading since 2004. So it might seem like I'm picking and choosing a lot of stocks that have performed super, super well. And to be honest, maybe I am. For them to outperform QQQ, they have to perform very, very well. And in this case, I own a lot of these. I do own ARCC, but this is the one that I am showcasing, doesn't exactly outperform QQQ. And there's a lot of stocks that don't outperform QQQ. There's a lot of stocks that don't outperform the S&P 500, that don't outperform the Dow. There's a lot of stocks that don't, but you have to be able to find the ones that you think will. And that's what I am choosing. That's what I find is the ones that have performed super well, that have the growth, that have the dividends, and the ability to continually pay high dividends with the factor of compounding that will make a massive difference in the end. So now we're going to go into our drip calculator, and we're going to one by one go through each of these and track what has outperformed QQQ and what has fallen short, showcasing why I love compounding investing with dividends. If you are interested in seeing all of my challenges all in one place, tracking all the outright numbers, Blossom is the app for you guys. I finally partnered with Blossom. I've been working on this for a long time. It is a social media type investing app. And what's really cool is it's free to download. If you use my link down below, that helps support the channel, and you'll be able to track all of my challenges, the weekly challenge, the weekly pay challenge, the yield max challenge, the growth challenge. Everything is on there. The high income challenge. All of the stocks I'm purchasing for everything on the channel is on there, and it helps me put more money into these challenges to entertain and inform you guys. So use the link down below. It'll be in the pinned comment as well. With Realty Income as our main symbol and QQQ plugged in down below as our other symbol, we're going to be comparing each one of these down the line. But I want to say there's a major factor with this, the compounding effect of these dividends. So let's start off. We'll see the difference. And it's distinct. you can tell right off the bat, Realty Income has outperformed QQQ significantly. 2,340% versus 912% since 1999 with dividends reinvested. Now, here's the main factor, though. Check this out. With dividends not reinvested, it goes to 936% to 814%. So both perform better with dividends reinvested because, of course, as the chart continues to head upward, every time you buy 1 share, 5 shares, 10 shares, you are then getting the growth for those additional shares on top of your original purchase amount. And if you guys don't know how compounding works, I recommend looking into it because to me, it is phenomenal. Who said, was it Warren Buffett that said compounding is the 7th wonder of the world or 8th? I can't remember how many there are. Honestly, I have to agree with that tenfold. Look at the difference that it makes. Realty Income, just price-wise, it has not outperformed QQQ. With dividends, it has. With dividend compounding, it significantly outperforms it. And this is going to be a reoccurring theme for a lot of these. At the end, I'm going to show you guys some of the newer ETFs compared to QQQ, and that'll give you more of an idea of how actual income-focused, only income-focused investing compares. But starting off really strong with Realty Income, let's check out Main Street Capital. A very similar story. We can see Main Street Capital's total return 1,400, almost 1,500% versus QQQ's 861% since 2007, because Main has not been around as long. And this is cool because it will compare them from the exact same time point, which I love. With dividends not reinvested, QQQ outperforms. Absolutely insane, actually. It performs significantly better, 550% compared to 773%. And so Main is still getting dividends. You're still receiving the dividends, a really solid amount as well. You're just not reinvesting them. And now with the special dividends on top of that, the reinvesting with Main Street Capital, especially recently, has just gone crazy. And that's why I like this one. The special dividends, the consistent dividend growth factored in over a long period of time, which is how I'm planning on investing, boom, you have a winner over QQQ. And again, QQQ's 13.78% return as an average, you're averaging almost a 14% return a year since 2007 is insane. That's amazing. Versus Main's 17. It's just slightly better. I mean, not even slightly. It's a couple percentage points better. And that's why. I always see people arguing with growth versus dividends. And yes, like I said, I love both. And it's hard to find a good stock that can do both. But they are out there. So let's check back in with our second REIT, Triple N. So again, we see another winner with dividends reinvested. And QQQ being the winner with dividends not being reinvested. And now that's the factor with these two. With income investing, a lot of people want to live off of the dividends. And that's amazing. And my goal is to eventually do that. I will say, I do not plan on reinvesting forever. I plan on reinvesting until I really need the dividends to live off of, aka in retirement. And that is my goal. So some insane differentials here. We can see total return, almost 1,700% with dividends reinvested, and then over QQQ versus the 9.27% since 1999. It's just crazy. 10K in each gets you 180K in NNN with dividends reinvested and 101,000 with QQQ with dividends also reinvested. And again, the same factor, average, your annual average total return, meaning the percentage return you're getting every year. QQQ, 9.27% versus NNN's 11.66 with dividends reinvested. We see that same number with dividends not reinvested. QQQ 8.84 comes out on top of Triple N's 7.82%. And that's the thing. If you understand your investment style and you can find a really prime stock that's going to grow with some dividends and some good dividend growth, it's hard to compete against. And then we have Altria Group, ticker MO, a dividend king, one of the most popular dividend stocks. Actually, are they even a dividend king still? Did they cut their dividend? Everything changed after the pandemic. I don't know where they stand now, but all I know is it's a very high yielding dividend stock. And we can see the difference. MO outperforms with dividends significantly with dividends reinvested. But of course, that means you have a long time in the market, right? Because that's how the compounding works versus dividends not reinvested where QQQ significantly outperforms, more than double, which is wild. So again, a 2,800% return from Altria versus 912% with drip on. Drip off, you only get under 400% from MO and a little over 800% for QQQ. These numbers, they don't lie. It's absolutely crazy what you're able to do with the power of compounding. And that really is the goal of this video. This video is not to show you, oh, growth investing sucks and dividends are where it's at. Because like I said, I love both. I love both, and I love stocks that can do both and ETFs that can do both. This is to show you that there's diversity. You can change up how you invest versus what you're wanting, depending on what you're wanting, on how your life is changing, on what your goals are. If your goals are income, you're not going to have this overall insane growth that we can get with the power of compounding. And if your goals are simply growth and you don't care about dividends, exact same thing. You're going to get some insane returns. 912% is a phenomenal return. It really is. 9.27%. You're making money with your money over time. You can just do more if you can choose these. I don't even know if you call them 1 in a million stocks, because there's a lot that have done it. Just for example, a lot of these that I own and the reason why I own them. But factors change, the stock market changes, and you have to go with the flow. So let's look at some that have not outperformed QQQ that I still own today. ARC versus QQQ. ARCC, I should say. We can see still two insane returns, over 1,000% since 2004. And wow, it's neck and neck. We can see the average annual total return, 12.6% from ARCC and 13.81% from QQQ. Overall, QQQ is the winner by a little over 300%, or a little under 300%. With dividends not reinvested, QQQ blows ARCC out of the water. ARCC has that nice 10% yield, which really pushes it and gets it consistent dividends, but it just hasn't performed as well as the other ones we've shown. And that's the thing. If you're willing to take the risk and maybe underperform some of these bigger growth ETFs by focusing on a dividend-focused stock or ETF, you can do it. That is what I personally choose to do, and this is not financial advice. I own QQQ. Like I said, I own VOO, I own SCHD, I own SCHG. I own a lot of these growth ETFs, and I counter them by having some growth stocks that pay high dividends and have great growth. And that's the thing. If you don't want to put all your eggs in one basket, don't. Diversify, split it up. Have some income ETFs, have some growth ETFs, have some stock that pays dividends, and boom, there you go. And now this is a really good example of one that's slightly underperformed. There are some that have performed significantly worse. And let's look at one that recently cut its dividend to nothing. Absolutely devastating. Used to be a dividend king. This is WBA, otherwise known as Walgreen Boots Alliance. Walgreens was a huge dividend king for a long time. I owned this one for a little bit and I was pumped, and it's been awful. They recently cut their dividend. Everything has been falling and they fell flat. And so this is the risk that you run into. Even with a solid dividend, it was in like the 6 to 7s for a while, maybe even 8% yield range, and they just couldn't keep up the price action. But this is a fear that goes with all stocks, and this is why people choose growth investing, primarily because you aren't likely to see QQQ have a return like this over the last decade. And again, with WBA, you would be negative. So you have two dividend kings. You have Altria Group and you have WBA. If you own them both, would they even out? Who knows? But that's something you have to factor in. Let's look at some income ETFs and see how they go against QQQ. We have JEPI, which has underperformed slightly. Well, not really even slightly. Percentage-wise, it is 99% QQQ versus 64% rounding up for JEPI. But there's something we need to factor in. JEPI has not had the time to grow. And I don't know how that will look. I don't know how it will do 20 years from now, if the dividends are going to look like a similar chart to Main Street Capital or Realty Income or Triple N. That's the thing. So it has underperformed now. You really have to have drip on for a long time to see how these will perform. So we'll look at one more income ETF, but I'm still happy with this. With dividends reinvest, I mean, it's still a solid return. You're getting a 64% return. Yes, you'd get more with QQQ, but longer time in the market, who knows how it would perform and who knows how QQQ is going to perform. It's all very speculative. And JEPI is a very popular ETF, probably one of the fan favorites, definitely one of my favorites. So same thing with JEPQ. QYLD is the original, I would say it's the original income ETF. It changed how we invest, really, for income investors, that is. And we can see it significantly underperformed QQQ. I did own QYLD at one point, and I did sell it when it was underperforming because that's how I like to trade. And it hasn't done terribly recently. But the total return of 106% versus 476% really hurts to look at. And that's with dividends reinvested. And QYLD was yielding 10+% for quite a while. With dividends not reinvested, I mean, it's significantly worse for QYLD, but not significantly worse for QQQ because they don't pay a lot in dividends. But all in all, a 4.43% average annual total return with dividends not reinvested and a 6.56 average annual total return from QYLD with dividends reinvested is not enough, in my opinion, when you're getting 10, 12% from something like QQQ. In this case, since 2013, it has averaged 17% returns. That is insane, an average annual of 17%. And that's the thing. You have to go with what you like and what feels, right to you. There are definitely some income ETFs that I think will surpass QQQ with dividends reinvested. The key thing is we don't know what they will be. I had to put it in. I had to throw it in the video, right? I had to. We can see a total return for ticker MSTY, the Yield Max MSTR fund. Total return since 2024, since February 2024, total return 234% versus QQQ's 2.13%. Now, this is by no means me saying to buy Yield Max ETFs or anything like that. I don't own MSTY outside of my actual, my Yield Max challenges and whatnot. I would say I'm a fan of the fund because the performance has been absolutely insane, but I'm not sure where it's going to go. Anyways, that's just on me. But look at this. This is the return. Even with dividends not reinvested, MSTY has absolutely blown QQQ out of the water, 163% versus, again, 2.19%. And that's just how it goes. Sometimes you get lucky. Sometimes the underlying stock goes absolutely nuts. In this case, MSTR stock has with the price of Bitcoin. And boom, here you are. And this just goes to show you, no matter how much DD you do, no matter how much you tell yourself, oh, this is the perfect way, there will always be new funds, new stocks, new markets that shift the way we think. And the goal is to be able to roll with the punches. I also wanted to say the interview with Ari is live. I will link it down below. Go check it out. Let me know what you guys think. I don't think I'm the best on camera with some of this stuff, especially these live interviews. We did not rehearse. I did not get the questions prior, but it was absolutely a blast, and huge shout out to Ari for everything that he did. All that being said, I hope you guys enjoyed this video. The key takeaways, I would say, invest how you want to. If you want to explore dividends and growth, do it. If you want to just stay with what you know, which is growth ETFs, growth stocks, do it. We all have the ability to grow, adapt, and learn, and that is what this channel is all about. Educating, informing, and entertaining you guys with what I'm doing and what I see other people doing as well in the stock market. So, as always, thank you guys so much for watching and supporting the channel. You are absolutely phenomenal. I appreciate you guys so much. If you enjoyed this video, chances are you're going to like these videos popping up on your screen right now. So check them out and let me know what you guys think. Thank you. Hope to see you in the next video.